The psychology behind every losing trade. There is a moment every trader knows. And nobody talks about it honestly, not the moment the trade goes wrong. The moment before that. The moment when something in your chest tightens, when your eyes stay a little too long on the screen, when your finger hovers over the mouse and doesn't move. That moment. The one where you already know, somewhere below thought, below logic, below everything your strategy ever taught you, that something is off. And you stay in anyway. That moment is what this episode is about, because the trade didn't kill you. That moment did. Let me tell you about Alex. 20-8 years old. Melbourne, Australia. Trades gold and forex from a spare room in his apartment. One monitor, a desk that used to belong to his grandfather, a printed copy of his trading rules taped to the wall directly above the screen, where he can always see it. Alex is not a beginner. 2.5 years in, one blown account behind him, a rebuilt account in front of him, and a strategy he genuinely trusts. He has done the work. He has paid the tuition. One Tuesday morning, gold is sitting at a level Alex has circled 3 times across 3 different sessions. The structure is clean. The setup matches every criterion on his printed sheet. He takes the trade. Long on Zoust. Stop placed. Target set. For 11 minutes, everything is fine. Then price pulls back. 30 pips. Nothing that breaks the structure. Nothing his plan didn't account for. Nothing that should matter at all. But something happens inside Alex's body that has nothing to do with 30 pips, and everything to do with being human. His jaw tightens. His breathing gets shallow, and a voice, quiet but insistent, starts speaking somewhere underneath his strategy. What if this is the one that doesn't come back? He doesn't recognize it yet, but that voice just became the most powerful force in his trading account. Here's what no course ever explains clearly enough. That voice is not weakness. That voice is not a character flaw. That voice is a survival mechanism 400,000 years in the making, firing exactly the way it was designed to fire, in exactly the wrong environment. Your brain was built for a world where losing resources meant genuine physical danger. It was built to treat loss as a threat, requiring immediate action. And it cannot, at a fundamental neurological level, distinguish between a 30-pip pullback on a gold chart and a real threat to your safety. Your nervous system does not know you're sitting at a desk. It thinks you are in danger, and a brain that believes it is in danger does not make trading decisions. It makes survival decisions. End the uncertainty. Stop the bleeding. Get out now. Every rational thought you have about the setup, about structure, about your edge, gets processed through that threat filter, and it loses every time. This is where losing trades are actually born. Not when price moves against you. When your brain decides that movement is a threat rather than noise. But stay with me, because something even more dangerous has already happened before that voice ever speaks. The moment Alex entered that trade, his brain quietly changed jobs. Before entry, it was analyzing. After entry, it started defending. His emotional brain had made a commitment to that position, and now, without Alex knowing, it was filtering every piece of information on the chart through a single unconscious question. Does this support what I already believe? This is confirmation bias. And in trading, it is one of the most expensive cognitive patterns that exists. Not because it's rare, but because it feels exactly like careful analysis when you are inside it. Alex isn't aware he's doing it. He thinks he's reading the chart. He's actually reading the chart the way his open position needs him to read it. The things that support the trade look clear and significant. The things that contradict it blur at the edges, explained away, minimized, quietly filed under probably nothing. Have you ever been deep in a losing trade and suddenly discovered 5 reasons why price was absolutely going to reverse? Reasons that weren't anywhere in your original plan? Be honest with yourself. That wasn't analysis. That was your ego building a defense. Jesse Livermore understood this a century before behavioral economists had a name for it. Livermore traded in the early 1900s, in markets that were raw and entirely unforgiving. No digital charts, no algorithms, nothing but a ticker tape, a room full of other speculators, and the merciless movement of price. He made and lost several fortunes in his lifetime, and at his absolute peak, during the catastrophic crash of 1929, while the rest of America was being financially destroyed, he was on the right side of history, shorting the collapse, profiting from the very panic that ruined millions. But Livermore also lost everything, more than once. And he was more honest about why than most people who write about him. He said the most dangerous thing a trader could do was fall in love with a position. Not fear it, not overthink it, love it. Because the moment you fall in love with a trade, he said, you stop seeing the market and start seeing what you need the market to be. Your analysis stops being objective and starts being personal. And personal analysis, in his words, was nothing but ego disguised as strategy. Think about your last losing trade. The one that got bigger than it should have. Was the decision to stay in based on what the market was actually showing you? Or was it based on what you needed the market to show you? That question has an answer. Most traders spend years avoiding it. Alex's trade is now 50 pips against him. The room is quiet. The city outside his window is already moving. Distant traffic, the kind of ordinary sounds that feel surreal when your screen is showing you something that isn't going the way it should. His coffee has gone cold on the desk beside him. The wall clock he never usually notices is suddenly very loud. He stares at the position. His original stop was at 30 pips. He moved it. Just a little, he told himself. Just to give it room. What he actually gave room to was his own emotional resistance to accepting a small, clean loss. And that resistance has a name that goes deeper than confirmation bias. It is called loss aversion, and it operates so far below conscious thought that most traders never identify it as the force running their worst decisions. Research in behavioral economics has established that the psychological pain of losing a sum of money is felt with roughly twice the intensity of the pleasure gained from winning the same amount. Lose $200, and your brain registers that experience with approximately double the emotional weight of winning $200. This is not a mindset issue. This is not something you can simply decide to think differently about. It is built into the architecture of human cognition, forged over millennia, because in the environment your brain was designed for, losing resources was a survival threat in a way that gaining them simply wasn't. What this means for a trader sitting in front of a live position is that your brain will work twice as hard to avoid confirming a loss as it will to secure a gain. It will generate justifications for moving a stop. It would manufacture reasons to wait a little longer. It will whisper that price always comes back, that the level will hold, that the setup is still technically valid. Because the alternative, accepting the loss, pressing close, confirming that you were wrong, registers as something close to physical pain. And so the trade gets bigger and bigger. And a loss that was supposed to be 30 pips becomes 100, becomes an account drawdown that costs not just money, but weeks of psychological stability. Not because the strategy failed, because the human executing the strategy couldn't tolerate the emotional experience of being wrong. This exact dynamic played out on one of the largest stages in financial history. The year is 2008. The global financial system is carrying positions that should have been closed years earlier. Mortgage-backed securities, complex derivatives, exposure that every risk model was quietly screaming about for months before the collapse. The people inside those institutions were not unintelligent. They were not unaware. The data existed. The warnings were there. But closing those positions meant admitting the losses were real. It meant confirming, in front of colleagues, shareholders, regulators, and history, that the bets had been wrong. And that admission felt, to the humans inside those organizations, More threatening than continuing to hold and hope. The result was the worst financial crisis since the Great Depression. Trillions of dollars in damage. Millions of lives altered permanently. All of it at its psychological core, driven by the same mechanism that makes a retail trader move a stop-loss in a spare room in Melbourne. The scale is different. The brain is identical. Stay with me, because what happens next with Alex is the part most trading content never reaches. His trade is now 90 pips against him. His account is down 4% on a position he planned to risk 1% on. And now he does the thing that turns a bad trade into something truly catastrophic. He opens another position. Same direction. Bigger size. No setup. No plan. Nothing except a desperate need to make the pain stop the fastest way. His emotional brain knows how, which is to win it back right now. This is revenge trading. And it is not an act of aggression toward the market, though it feels that way. It is an act of self-preservation gone completely wrong. The emotional brain, overwhelmed by loss and the identity threat that comes with it, grabs the controls from the rational brain and starts driving. Fast and without direction because movement feels better than SDI. Stillness because doing something feels better than sitting with what just happened. It almost always makes everything worse. Paul Tudor Jones built one of the most celebrated careers in macro trading history on a principle that sounds almost counterintuitive until you understand everything we've just walked through. He has spoken publicly for decades about the fact that he thinks about losing money constantly, not as pessimism, as discipline, as the deliberate, daily practice of keeping his ego away from his positions. On Black Monday in October 1987, when the Dow Jones Industrial Average fell over 22% in a single trading session, the single largest one-day percentage decline in its history, Jones was positioned for exactly that kind of event. Not because he knew the exact date, because he had spent months preparing for downside scenarios that felt, to most traders at the time, too extreme to take seriously. He played defense when everyone around him was playing offense. And when the crash arrived, he was ready. The lesson Jones embodies is not complex. It is simply the hardest thing in trading to actually do. Ask yourself what you can lose before you ever ask yourself what you can make. Let that answer sit at the center of every decision. And when the answer makes you uncomfortable, treat that discomfort as information rather than something to push through. Here is the practical truth that everything in this episode has been building toward. Your trading plan was written by the best version of you. The calm version. The rested version. The version that wasn't staring at an open position at 11 o'clock at night with a red number on the screen. That version of you knew your risk tolerance. That version knew where the stop belonged and why. That version made good decisions. The version of you that moves the stop, that closes the winner too early, that opens the revenge trade, that isn't your trading mind. That is your survival brain, doing its ancient job in a completely wrong environment. The structure you build around your trading, your rules, your risk limits, your hard stop placements, exists specifically to protect your trades from that version of you. Not from the market, from yourself. From the moments when the voice starts speaking and every instinct you have will tell you to do the worst possible thing. Alex eventually closes both positions. The room is silent except for the rain and the clock. The screen glows in the gray morning light. He sits for a long time without moving. Then he opens his notebook and writes one sentence. Not a new strategy. Not a new rule. Just one sentence. I didn't lose to the market today. I lost to myself. He closes the notebook, sets it beside the cold coffee, and for the first time in hours takes a full breath. That sentence is the beginning of something. Not the end of losses, because losses will always be part of trading, but the beginning of a different relationship with them. A relationship built on honesty instead of blame, on process instead of ego. on the slow, unglamorous, completely unsexy work of becoming a trader who can feel the fear and follow the plan anyway. The market doesn't owe you anything. It never did. It is not cruel, and it is not kind. It simply reflects the sum of human decisions, made by millions of nervous systems exactly like yours, all wrestling with the same ancient biology in the same modern environment. The only edge that has ever mattered, the one beneath every strategy and every indicator and every risk management framework, is this: knowing yourself clearly enough to get out of your own way. The market will open again tomorrow. And the episode that follows this one is going to take you somewhere most trading content has never gone. Into the hidden pattern running underneath self-sabotage. The one that doesn't look like a mistake from the inside. The one that feels like logic, sounds like discipline, and quietly destroys more accounts than fear and greed combined. You won't want to miss it.